Hey everyone, welcome back. Today we're diving into a real head scratcher in economics. Why is it that those booming periods, with all the innovation and investment, sometimes just take a nosedive into a financial crisis?
It's a classic economic mystery, right?
Totally. And we're going to try to unravel it today using this book as our guide, Macroeconomics and Financial Crises Bound Together by Information Dynamics. Sounds intense, but trust me, we'll keep things interesting.
Yeah, the book's really thought-provoking. It kind of flips the script on how we usually view these things.
Yeah.
Suggests that the seeds of a crisis are often sown during those good times, right there in the boom itself.
Okay, so can we ditch the jargon for a sec?
Sure.
We've all heard of credit booms, right? Money's flowing, new businesses are popping up left and right, everyone's feeling good. But if they're fueled by positive stuff, like you were saying, why do some just go bust?
Yeah, that's the million-dollar question, isn't it?
Yeah.
The book says it all boils down to information, or actually the lack of it.
Information. That seems kind of subtle. I always figured crashes were more about bad loans or some kind of big mistake.
Well, those often play a role, sure. But consider this. Short-term credit markets, those are the ones that keep the whole economy humming, right? Well, they rely on speed.
Right. Things move fast.
Exactly. Imagine if, Amazon took weeks to approve every purchase.
People would lose their minds.
Right. No one would buy anything.
Mm.
Lenders need to make quick decisions. That means a certain level of, let's call it information blur, is actually necessary.
So a little bit of blind trust keeps things moving.
In a way, yeah.
But too much, and that's where things get risky. And that's where this whole information depreciation thing comes into play, right?
Exactly. The book argues that as a boom keeps going, the information about loans, mortgages, business loans, all of it, it gets kind of murky.
Murky, how so?
It's like everyone's caught up in the excitement. They forget to check if, the brakes still work.
Okay, so information gets fuzzy, everything's moving fast. But how does that actually tip over into a full-blown crisis? Is there one big trigger?
Well, what's interesting is it's often more subtle than that. This book looked at data from 34 countries over 50 years, and it found that the bad booms, the ones that go bust, they're often marked by this slowing productivity growth before the crisis even hits.
So it's not just that innovation stops, it's that the pace of it slows down.
You got it. That's a really important distinction.
Right.
It's like a car that should be accelerating, but it's gradually losing steam instead.
Perfect analogy. That's a bad boom in a nutshell.
Wow. And this slowdown, it can be happening even when, overall, the economy seems fine.
That's what's so tricky. Those traditional economic indicators, they can be misleading.
So you've got this hidden problem, this information gap, and then something happens, could be a small recession, interest rates jump up, some event disrupts the easy credit flow, and suddenly this seemingly minor event becomes the straw that breaks the camel's back.
Just like that.
And bam, financial crisis.
So we've got this situation where information, or the lack of it, is setting the stage for a potential crash. But you mentioned the stock market earlier. What's the connection there? It seems like a whole other beast.
It is. And that's what makes this so interesting. While those credit markets, especially in the short term, rely on a degree of, let's say, opacity. The stock market thrives on the exact opposite.
Yeah.
Information, and lots of it.
Okay, now you've got me intrigued. Tell me more.
Think about it. The stock market, it's all about information. Companies' plans, their risks, their performance, all of it. It's constantly being analyzed, debated, and then reflected in those stock prices, right?
Right.
Investors, they're making bets based on this constant flow of information.
So the stock market is this giant collective brain that's always crunching data.
Exactly. And here's where it gets even more interesting. This information flow, it can actually counterbalance those, let's call them murky credit markets we were talking about before.
Wait, hold on. So the stock market, a place that's notorious for wild swings and speculation, can actually make things safer. How does that work?
It's all about providing that alternative source of information, right? So let's say there's a company that wants to take on a ton of debt for some new project.
Okay.
Well, that information, it's going to be all over the stock market. Investors, they're going to scrutinize it. And if they think it's too risky,
the stock price tanks.
Exactly.
Which makes it way more expensive for the company to borrow money.
You got it. Lenders, they see investors getting nervous, and they start to get cold feet too.
So it's like the stock market acts as this early warning system.
Precisely. It's like a pressure valve, releasing some of that risk before it builds up too much in the credit system.
Wow, it's blowing my mind a little. Okay, so we've got these two seemingly opposite forces, these shadowy credit markets on one hand, and this information-hungry stock market on the other. They're actually interconnected in this strange dance.
That's it. They're part of the same ecosystem.
Hmm.
And understanding that interplay, it's crucial for really getting how booms and busts happen.
This is so interesting. Okay, so
Fun.
we've covered a lot of ground here, how information or the lack of it can make or break an economy. But before we wrap things up, there's got to be one more big takeaway from this book. What's the final thought you want to leave us with?
Well, the book focuses a lot on governments and central banks and how they try to manage these cycles, but it also asks a question that's relevant to all of us. In our crazy, complex, fast-paced financial world, how do we ensure that access to accurate information keeps up with the speed of, well, everything else? The speed of the transactions themselves.
That's a great question. I mean, we're talking about this global system where literally trillions of dollars are changing hands every single day at lightning speed if the information can't keep up.
It's like trying to fly a spaceship with a car's dashboard.
Exactly. We need a serious information upgrade if we want to avoid making the same mistakes again and again.
And that's something for all of us to consider, not just the economists and the policymakers. It affects everyone.
You know, you've left us with a pretty big challenge here. How do we actually bring our information systems up to speed with this crazy 21st century financial world? It seems like a huge task.
It's definitely complex. But there are some really exciting avenues we can explore. Technology is a big one, of course.
Of course.
We're already seeing the potential of things like data analytics and AI. They can actually help us make sense of these massive amounts of financial data in real time.
Wow.
Imagine that, like a financial early warning system.
So using technology to make the invisible visible, give us a clearer picture of the whole financial landscape.
Exactly. But it's not just about, having the information. It's about making sure the right people are seeing it at the right time.
Right.
Think about how transparent things are in the stock market compared to, say, the world of shadow banking.
Right, right. Which operates with far less oversight.
Right. Shadow banking,
Right.
it's all those financial activities happening kind of outside the traditional systems, more like a black box, you could say.
Yeah.
Less transparency, more room for trouble to hide.
Exactly. And that's where this balance of innovation and regulation becomes so important. We want to encourage these creative solutions in finance, right?
Right.
But not at the cost of creating more of those blind spots in the system.
Yeah, it's a real balancing act, isn't it?
Totally.
Too much regulation, you stifle progress. Too little, and you're just asking for trouble. But, alongside all of this, shouldn't we also be thinking about individual investors? Everyday people need to navigate this complex world, too. Oh, absolutely. Financial literacy is so important. The more people understand about how these markets actually work, the more they can start asking the right questions,
Right.
assess the risks, not get swept up in all the hype.
Knowledge really is power in this game, isn't it? And it's not even just about understanding all the technical stuff. It's about having like a healthy skepticism,
Yes.
not taking everything at face value, digging a little deeper, asking why a little more often.
Exactly. It's about empowering people to make informed decisions, understanding that their actions have these ripple effects throughout the whole system.
So well said. So as we wrap up this deep dive, I think the biggest takeaway for me is that we can't just be passive bystanders in this financial world. Understanding how it works, asking questions, demanding transparency, that's how we build a more resilient system, a more equitable system for everybody.
Couldn't agree more. Information is key, and how we choose to use it, that's going to determine the future of the entire economy.
So true. Listeners, the next time you hear about, a booming market or a financial earthquake, remember what we talked about today. Don't be afraid to ask the hard questions. Seek out that reliable information. Be an active participant in this whole financial conversation. Knowledge is your most powerful asset.
Absolutely. Until next time, keep learning and keep asking those critical questions.
That's a wrap on this deep dive. We'll be back soon with another fascinating topic. Until then, stay curious.